Now, it's just telling you that any of them you want to consider, the return must be above that 18.08%. So inflation is the first consideration. The likelihood of you, not of you as an investor not getting your money back is there. So which is a major risk. Your expense ratio. So how much is management of that mutual fund taken away? Because that is exactly that will equally affect your mutual fund.
And welcome to Everyday Money Matters on Nairametrics Television, the trusted guide to making smart money moves in today's economy. I am Oge Obierika, and today we are focusing on mutual funds, one of the most accessible ways to grow and protect your wealth, especially as the market shifts. With the central bank easing interest rates and inflation a little above 18%, the naira showing mixed performance, many Nigerians are wondering if this is the right time to invest in mutual funds and which ones will protect your portfolio. Joining me to unpack this is financial analyst and investment advisor Idika Aja. Hello, Idika, and thank you for joining us.
Yeah, okay. Thank you very much for having me.
Let's start with the big picture. Given the current economic climate, why should investors consider mutual funds this November?
Okay, thank you very much. First of all, let me just explain what mutual fund is. Mutual funds, for instance, very simple way is a basket of maybe like a basket with various fruits you have inside the basket. So the end is to at least make you healthy. That is the essence of mutual fund. Mutual fund is just a basket holding different asset classes, which you can now invest, and those asset classes are managed by professionals. So you don't need to worry yourself which one to pick or which particular one to pick and which one to drop. So they are managed by professionals. That is actually what we mean by mutual funds. And there are various types of mutual fund. You have a money market mutual fund. You have equity-based mutual fund. You have balance fund mutual fund. You have a dollar mutual fund. Then you have a real estate investment mutual fund. So it really depends. So there are many of them. Now, to your question, you said which one, if I'm right.
Why should investors consider mutual funds this November?
Okay, why investors should consider mutual fund this time around? Now, one, there are variables that control whether you want to go for mutual fund or whether you want to go to the underlying asset. What I mean by underlying asset, something like stock, bonds, treasury bills. You know, mutual funds is a collection of pools, funds from different investors. They will now use it and buy what we call the underlying assets. So when you talk of equity fund, that means they have to invest in stock. If it is fixed income, they have to invest in bonds, treasury bill. Then just like that. Now, the major driver, whether or why or when to consider one depends, one, on the return you are looking for, the macro economic factor that is controlling that return. And in this case, we are looking at inflation and rates. Now, inflation is now, from what you said, is about, I think, 18.08%. Right? Now, it's just telling you that any of them you want to consider, the return must be above that 18.08%. So inflation is the first consideration. Okay. Now, at 18.08%, you now look at those mutual funds that can give you return above that inflation rate. That is just the key thing. Otherwise, you'll be losing money. And if you use the Securities and Exchange Commission data, I think as at October 17, look at their year-to-date yield. You look at those funds that are giving you a return above that 18%. For instance, equity-based mutual fund on average is given around 54%. So you see, it's higher than that inflation rate. Money market mutual fund is given barely on average about 18%. That doesn't mean that there's some fund managers there particular funds there that are equally performing above that average return. But let us use the average return, 54. Then I think a balance fund is giving about, exchange traded fund, is giving about 45%. Then balance fund should be about 23%. So you can see the return.
Mm-hmm.
So these are the things that you have to consider. Why you should invest depends on your return. That is basically the first thing you have to consider.
Now, how has the recent monetary policy shift impacted returns of mutual funds so far?
Okay, like I said, when you invest, you derive the investment from an underlying asset. Now, for instance, equity-based mutual funds, that means you invest in stock. Fixed income mutual fund, you invest in bonds, treasury bills. Now, let us use that bond and treasury bill for instance. If the rate comes down, the yield on fixed income assets will definitely come down.
Mm.
So if they come down, that means the yield from that mutual fund, remember what I said, fixed income mutual fund will definitely follow because they mimic the underlying assets where they pick that, where they invest. Now, rate is at, MPR is at 27, down from 27.5, now at 27. Now, if it continues to decline, definitely yield from that fixed income space will drop. And that means people, you can see the last auction that was done, especially treasury bill, which was oversubscribed. So people now in anticipation that, okay, by the time they meet again this month, at least there are people, investors are anticipating that, okay, fine, in a worst case scenario is that they will return the rate. But they're expecting that the rate, they will drop rates because inflation is coming down too. So if they do that, so people are anticipating that, okay, if they do that, likely the yield will continue to drop.
Mm-hmm.
So you see how rate influences your choice
Of funds.
Yes. So now, at that now, you can see the money market mutual, the equity mutual funds. People will start moving towards equity mutual funds. As a matter of fact, an investor, you start considering, if you are not too grounded to know which particular stock to buy, or you don't want to waste your time, then you can now pick equity-based mutual funds. Then give them money, because they are going to buy stocks, because that is the underlying asset there.
Now, earlier on, you likened mutual funds to a basket full of goodies. So what categories of mutual funds should investors be paying attention to right now? Is it money market? Is it fixed income or balanced funds?
Okay, that's a very good question. One, everything depends on what we are looking for as an investor. Are you looking for stability? You're looking for return? Normally, the return and risk. If you are going for equity-based mutual funds, definitely it will give you higher return, but higher risk. So are you ready to stand with the volatility? So if so, then you go for equity mutual funds. But if you want stability, guaranteed income with a little risk, you can go for balanced funds. Balanced fund means that it's a mixture of stock and fixed income. Of course, the return is higher than fixed income alone, because now it's a mix of equity and fixed income assets.
All right.
So it really depends on what you want. If you are that risk-tolerant investor, of course, you go for equity-based mutual fund and exchange-traded mutual funds. All of them, two of them, they derive their strength from stock. The underlying asset there is the stock. So, but if you are a risk-averse investor, you can go for, especially for me, money market mutual funds, because money market mutual funds on average gives 18% based on based on the reports, SEC reports. So, which is higher than the fixed income return, average return.
Now, for someone who is more focused on protecting their portfolio than chasing big returns, which would you recommend?
You have to work out what we call the risk-adjusted return, normally measured by Sharpe ratio. So it's not that you just go pick. So that is where your investment advisor will come in if you don't know, because you have to, for you people to know. Yes, equity mutual fund might give you higher return, but what is the level of risk? How much are you paying for that risk? So that's what we mean by risk-adjusted return. If you check it very well, you can see even Treasury bill standing alone at 17%. That is 1 year Treasury bill at 17%. Assuming like equity mutual fund gives you 54%, exchange traded fund gives you 45%, money market mutual fund gives you maybe like 18%. Then if you rank them in terms of risk, of course, let's say 5 for equity-based mutual fund, 4 for balanced mutual fund. Of course, down to money market mutual fund will give you maybe around 2. Then 1 for Treasury bill. See, by the time you adjust, bringing the risk aspect of it, you can see that though the equity-based mutual fund and the exchange-traded mutual fund definitely will give you higher return, but with higher risk. Mm-hmm. So like I said, it all depends on what you want. But for me, I will balance it, because the essence of the whole thing is to maybe, depending if you want to balance your portfolio, what target return, portfolio return are you targeting? Is it 40%? Is it 50%? Or is it 30%? That will now give you the mix of which of your exposure in each of the asset classes.
Mm-hmm. So you recommend balancing it?
Yeah, sure. Balancing, at least you take risk if you balance it. Because let me just, because someone just called me, said, okay, even after explaining to somebody wanted to find out, after explaining to the investor, mm-hmm. said, okay, I said, okay, for money market mutual fund, yes, the return might be, okay, let's use average return of 18%. That's what it gives. Now, definitely, what will fluctuate is the return, the interest accruable, but your principal is still there. That means your investment amount is still there. Mm-hmm. I mean, if you put in 1 million naira and they're giving you 18% per annum, for some fund managers like Stanbic IBTC, they pay quarterly. So at the end of every quarter, they will now calculate the interest accruable and ask you if you want, you can roll it over, or they ask you to redeem it. So you can see that your principal maybe in this case, 1 million naira is still intact. So if rates drop, it will affect the yield, the mm-hmm. interest accruable, but your principal is still intact. That means if we are getting about 18%, let's say 18,000 naira, and the interest they readjust and say 15,000 naira, you get 15,000 naira, but your investable amount, which is 1 million naira, is still there.
Right.
So unlike what you have in equity-based mutual fund, whereby the volatility in the equities, the stock, the underlying asset will definitely affect your net asset value.
Mm-hmm. Well, inflation remains a major concern for most Nigerians. That said, can mutual funds genuinely help investors preserve their purchasing power in this environment?
Sure. I've said it. Depending on the type of mutual fund.
So what specific fund strategies are proving most resilient against inflation right now?
One, the ones that are giving you returns above inflation. And even when you are doing that, there are certain things that you have to watch out for mm-hmm. to ensure that, okay, the return beats the inflation. And that has to do with the fact sheet of those fund managers. How much are they even actually charging you? That will now determine how resistant, how well the fund can resist inflation. Because the end point, like we already mentioned, is the return coming in to be above that inflation rate. So, but there are factors that can now influence the actual return coming to you. Some of them, like the expense ratio. So as an investor, even before you invest, you have to check that in an expense ratio. How well are they diversifying? I mean, the fund managers, if it is equity funds, where are they putting, are they investing? So these things are very, very important to be able to know how resistant their investment or the particular mutual fund you are selecting will perform.
Let's talk more about the risks. What are some of the biggest risks that retail investors face when investing in mutual funds today?
Okay. When you talk of risk, one is linked to that to the type of mutual fund you are taking. If you are taking, for instance, money market mutual funds, I've mentioned it. The only risk there is that the return volatility, which means that if rates continue to drop, your return might drop. Now, if you take, for instance, dollar mutual funds, of course, the risk there is the exchange rate risk. That's what you face. If the exchange rate fluctuates, if you appreciate or depreciate, it will affect your investment. Then overall, these mutual funds are not risk-free investments. What I mean by risk-free investments, that the likelihood of you, not of you as an investor not getting your money back is there. So which is a major risk. Normally default risk. The only asset class that is risk-free is government asset, maybe federal government saving bonds, treasury bills. So the major risk there as a retail investor you are going to face generally is default risk. But I think nobody has really gone to say that he has not gotten his money. So, but apart from that, then you have other specific risks. The company, the particular mutual fund, how strong is that mutual fund? The management, you look at the top big ones that are very strong with good net asset value, Stanbic IBTC, Chapel Hill Durham. So those are the big mutual funds and which you have to consider before you even start invest, so that you reduce some specific risk.
We'll come back to these other options like the government saving bonds and treasury bills, but how can a person check that a fund is well managed and not overly exposed to market shocks?
Okay, like I've already mentioned it, how you can check one, first of all, the most important is that you have SEC. You can check regularly with SEC. Most of them check SEC. What is their report on any of the mutual funds? Is the report okay? One, you check the fact sheets of the mutual funds, how regular, how consistent that mutual fund has been in releasing facts about their investments. That is very, very important that you must do that. Then, like I mentioned earlier, your expense ratio. So how much is management of that mutual fund taken away? Because that exactly will equally affect your mutual fund. Your return you are getting from that mutual fund. How much is very, very important. Some of them, they do charge 1 to 3% of your actual investment and deducted from your return.
So an investor should consider all of that.
Yes, at times you will not even know. So anytime you want to invest, check the mutual fund fact. That's what they call fact sheets. So check the mutual fund fact sheets. Find out, they will give you all the details there. That will now, at least if there's any risk, you can check out, look for it, and maybe say, okay, this one is okay. So we will give you a expense ratio of 0.5%, and we'll give you maybe 1%. So this is 1% we are collecting from you. If another mutual fund gives you 0.5%, and you check the return is giving you. If the return, this one is giving me, it's the same thing with this one is giving, but this one is taking 1% expense. The expense ratio is about 1%, and the other one is 0.5%. At least by just looking at it, you know that the second one, the one that's giving you 0.5%, is better.
Now, let's come back to these other alternatives that you mentioned earlier. How do mutual funds currently stack up against these safe options like the government saving bonds and treasury bills?
Okay. Let's say treasury bill now, 1 year treasury bill. I think as at last auction, stop rate should be between around 16.5 thereabout, 16.5% thereabout. Then 90 days should be about 15.5%. The other one, I think 15.7%. I'm not too sure. Now let's us use the 1 year treasury bill rate. Let's assume it is 17%. That is what it's offering. Now, remember, it's different from mutual funds. So 17% means the money will be paid to you upfront. If you are buying 1 million, they will then calculate the yield and deduct less 70%. One, it gives you the opportunity to reinvest that 17% from whatever amount you are investing. That means you avoid one. You are going to avoid what we call reinvestment risk, because if you are going to reinvest, you are reinvesting at that rate you are giving you. So that solves that problem. Now, you go back to mutual funds. This one is a risk-free asset. Whatever happens, you are most likely to get your money. Now go to mutual funds. Remember mutual funds, if it is money market mutual funds, they will use that the professional will now collect that money and invest in what? Short-term instruments like this treasury bills, savings bond, commercial papers. But it is not a risk-free asset. So it has some element of default risk. Now, and they should give you return more than that 70% to compensate you for that risk you are taking. So if they are not, then it is not good. For instance, on average, money market mutual fund is giving you 18%, but that is not what all of them. There are some that are giving up to 20%, some that are giving up to 22%, and are giving up to 23%, some 25%. So you check and find out the one that is giving you return more than this treasury bill, 1 year treasury bill. So you balance it. And again, apart from the risk premium, you check the one that is giving you more return above what the risk-free asset is giving you. You want to look at, is it higher than inflation rate? So those ones that are giving you 20, 22, 23, above that, those are the ones that you consider. There are a lot of them. If you check the SEC report, you see a lot of them. Stanbic IBTC, a lot of them. But I'm just giving you the average return, which is about 18%, which is just equivalent to the inflation rate, and equal maybe 1% higher than treasury, 1 year treasury bill. Now, if you go to the equity side, equity mutual funds, that is where you have that spread, 54% on average. There are some of them that will give you, that even trading below that average return. So you can see the difference now.
So to reiterate, Idika, at what point does it make sense to shift from a money market fund into longer term instruments?
Well, one, it depends on actually what you are looking for. If the rate, like now, the rates, let's use, assuming we're expecting that rate will come down. By the time MPC meets this month, they might decide to cut rate again. Like I said, if you cut rate, it will affect the yields on fixed income assets, and people will tend to move towards equities. That is one. Secondly, you look at equities now. The stock market is rallying on a bullish note. So that means those mutual funds attached to equities are really doing very well. So what will determine when you are likely to move or what you are likely to is the general market trend. How is equity doing? The underlying asset doing? If it is real estate investment trust funds, mutual funds, how is the real estate doing? If it is money market mutual funds or fixed income mutual fund, how is that space doing? The yield. Is government going to cut rate? If no government is going to cut rate, we anticipate, you know very well that that will now affect the yields from that fixed income and even treasury bill space. Now, I think savings bonds, the one they are issuing today, 2-year savings bond is giving you about 13.6%. Why 3-year savings bond is giving you about, 14.6 thereabout. So you can see the 14%. You can see the equity mutual fund about 54% on average. So what will determine when to move is the general situation, microeconomic variables, their movements. That will tell you, okay, inflation is coming down, rate is coming down, Fed is coming down. People will likely leave the fixed income space and start migrating to equity. Now, results are being released. People are taking position in the equity. And as they are doing that, definitely the underlying asset, which is for equity-based mutual fund, that is why it is doing very well.
Right. Great insight, Idika. Thank you so much for breaking all of that down so clearly. So whether you're investing for growth, for income, or to preserve value amidst uncertainty, mutual funds is definitely a smart way to diversify. But as we've all heard, it all boils down to understanding the risks, the fees, and strategies behind each one. And that is on this edition of Everyday Money Matters. Don't forget to follow Nairametrics on all social media platforms for more tips on making smarter, wiser money decisions. I am Oge Obierika. Thank you for tuning in. And until we meet again, stay safe.